Okay, let's get started. Let's start out, first of all, are there any questions or comments about anything that's going on in the world? Okay, the world of finance. Any comments or questions today? We've had a relatively quiet weekend, which still means it's been exciting out there these days, but compared to what's been happening lately. Any questions about the homework, or I mean not the homework, the project, or anything like that? Or any administrative or technical material, okay, at the start of class? Okay? Let's start going once, twice, 3 times. Okay, what I'd like to talk about today are options pricing. We've been talking a lot about options, and we've been talking about prices of options, okay? Remember, call options give you the permission, the right but not the responsibility to buy a stock at a particular price, okay? Put options give you the right but not the responsibility to sell options at a particular price. And we've talked a lot in recent days about what what these options are and how you can build things with them. Last class, I guess, we talked about how you can combine using puts and calls, okay, in creative ways to buy, to profit from a variety of different conditions. This is a page. If you go to Yahoo Finance actually has one of the better, let's say, online finance sites. If you go to finance.yahoo.com, you can get prices on all kinds of different, all stocks. And here are prices on options you can get from them. It should be relatively easy to find. You go to your favorite stock page, and there's a window there for options. And when you go there, this is a representative options price quote page. Okay? And it's probably interesting to look at what you see here and what it means. So the top bar, okay, over there, first, this is for General Electric, which is one of the largest companies in the United States, okay? This particular page is giving you quotes on both puts and calls, okay? And there's a different page for different expiration dates. So when you go and buy options on an exchange, they're standardized contracts. That's part of the deal about them, right? And in this case, there are standardized expiration dates of September, October, December, January of 2009, May 2009, January 2010. This is the page of quotes for what are General Electric's options going to be selling for. What are the prices of options to buy General Electric? Okay, with a strike date of January 2010. Okay, the left column, the symbol, since these are sort of securities that are traded on an exchange, they're standard contracts. The left symbol would give you the description of that contract, the pointer, the ID, if you wish. Okay? The last column tells you what was the last price that option traded at. Okay? So in this particular case up here, this option here, the last trade was at $19.50. What is it? Well, it's a call expiring January 15th, it looks like, 2010, at a strike price of $5. Okay? So the center column here is discussing the strike price, and the strike prices go from $2.50 all the way up to $60 here on these particular contracts. Okay? And what it's telling you now is, let's look at what we see here. This is the last sales price. The current price of General Electric, if we see in the upper corner when I made this slide, was $23.39. Why is it that these call prices are shaded? What is the difference here? This is where the call prices switch from $20 a share to $25 a share. So which sets of calls would currently be in the money? Okay, if the stock price is $23, which set of calls right now have value? The ones above 23 or the ones below 23? The ones that are above it, right? You have the right, if you wish. This guy is sitting here, actually, with the right to... Actually, it's the ones below it that are in the money. Excuse me. A call is a permission to buy something, right? If the stock price is $23, you would want permission to buy it at as low a price as possible. Does that make sense? And so long as you can buy it at a price that is lower than the current selling price, you should feel pretty good about yourself. Does that make sense? So all of these options are right now in some sense in the money. If we suddenly got into a time machine and it was 2010, January 15th, we could cash in the options and we could make a profit from them. Okay? But what do we see here? First thing to note is that as the strike price gets higher, okay, and goes down, the price of the call option goes up. Does that make sense? Okay? Because you have the right to buy it at that price. The lower that price is, the more the more valuable the option is. How many people get that? Okay, that's an equivalent. How many people don't get that? Okay, that's good. So we see that in the options prices, there are option prices, okay, and that they go in this case from 8 cents all the way up to 19 cents, $19 for buying a call option on General Electric a year plus from now. Okay? Any questions about that?
Why is when it increased from 0.08 to 0.1?
Okay, so now this is showing you what was the change in that option price. Okay? Now changes are, these things are being sold, they're supply and demand issues, right? Okay? So the change column, this last is saying what's the last amount that anybody paid for this option. Okay? The change is showing how did that change from the previous day's last price, presumably. Okay, some comparable price. Did it go up or down in price? Okay, we see some went up, some went down. There's two columns for bid and ask. And those are actually kind of interesting ones that we didn't really talk about so far. In many markets, including options markets, okay, there is a guy who's called a market maker. What is a market maker? A market maker is like the guy that sits at a foreign exchange counter. Remember when you go to the airport, you need US dollars? There's a guy there saying, well, you want to buy US dollars from me? I'll give you this many Hong Kong dollars I'll give you US dollars for this many Hong Kong dollars. You want to sell US dollars to me? I'll give you this many US dollars for this many Hong Kong dollars, right? And he profits from the spread between what he's giving the people who want dollars and what he's giving the people who want Hong Kong dollars. Does that make sense? So likewise, there is a guy whose job it is called the market maker in certain markets, like in this particular option market, who's always willing to buy options and always willing to sell options. Okay? And the bid and ask price are his current spreads. What he's willing to pay if you want to sell him one, and what he's willing to charge you if you want to buy one. Does that make sense? Okay, and so this gives the spread here gives you an idea of what his range is. On the more tightly traded options, the ones that are being sold a lot of, see the large volume and the large open interests, there's a very tight window there. Because he knows that there's people on both sides of the equation, okay, who will want to buy and sell, and he can make money from a relatively small spread. For the weird options, there's less volume in it, okay, and so there is a bigger spread there, okay, to make sure that, to compensate him for the risk he's taking both sides of the expression. Any questions about that? Okay. There is also what they say the volume. The volume is how many of these contracts got traded that day. Okay? So the fact that this secured option had zero volume, in fact zero open interest, means that nobody actually wants this thing. Okay? Nobody thinks that is particularly interested in buying a call option at some very large price to buy General Electric at $2.50 in 2010. Okay? If we look at it, there tends to be more interest right around the points where the stock is currently trading. Okay? That's where, let's say, the options are more interesting. Okay? Because there's more doubt, will you be on one side or the other of it? Okay? Does that make sense? A question about anything would be interesting. Okay? Any questions about what any of these columns mean? Yes?
What's the difference between volume and open int?
Okay, open interest is an interesting thing. Now, when we talk about options, how many options are traded at one time? Okay, if we think about it, what is the limit on options? Okay, on how many options can be offered on General Electric at any one time? The answer really is there is no fundamental limit. Because an option is simply, there's a call option, and someone buys it and someone sells it, right? So long as there is someone willing to sell a call option, there's one person who wants to sell and one person who wants to buy, you can create a new one at any moment. Does this kind of make sense? Let's think about this. Could I create a new call option? Well, if I decide I want to sell a call option, I could go to the exchange somehow, in some sense, at least theoretically, and say, I'm willing to sell a call option now. Add it to the pool of call options to buy. Right? You'll have to pay me for this option. But I can create this thing as the market needs it. It's not like a supply and demand thing, where there's a fixed amount of supply. So long as somebody else wants to take that side of the deal, it's like writing a forward contract. So long as there's people who want to write these contracts, you can create more of them. Does that make sense? So in the beginning, although there's theoretically an option to buy GE at 2.5, no one has bothered to write one. Okay? No one has bothered to try to buy one. And no one has, succeeded in selling them. That's why the open interest is zero. The number of options outstanding, okay, is basically equal to the open, is what they mean by the open interest. So what does this mean? This means that today there were 17,000, okay, of these particular options bought and sold, right? Over the lifetime of the deal, 89,000 have been created, okay, or are still around. Remember, somebody could take a call and a put, and they can sort of neutralize each other, right? So somehow someone bought a call and sold a call. They could somehow be combined back to zero again. The number of options that have not yet been so destroyed, okay, is the open interest, okay, and it measures how many of these contracts are out being traded. Any questions about that? Yes.
Typically, market and options limited by the number of stocks available to cover.
Okay, number of shares. So in principle, one would say that the number of options should be, since you're promising to deliver a share of stock at a particular price, in theory, the number of options that can be offered should be upper bounded by the number of shares that can be offered, okay, which is the total number of shares in the stock. Sometimes you hear about naked options. A naked option is one that isn't covered, but is sort of, where there isn't actually a physical share backing it up, just a promise to pay it and settle it in cash. So bottom line, I would say is that for our purposes, if you don't have naked options, okay, then in principle, the open interest is bounded by the number of shares of GE that are available, that are out there.
And so that for any for any particular description, or sum over all options, sum over all the instructions?
I am going to guess the sum over all. Presumably, it should be the sum over all contracts. Although, let's say I'm not sure about that. That's a regulatory issue here. Okay, and let's say I'm not sure actually exactly what the upper bound is here. But either if the options exchange works by requiring you physically show a share for it, then presumably it's upper bounded, that the sum is going to be equal to the number of shares. Okay? If the exchange's rules are laxer, okay, or permits these naked options, then presumably it could be higher than that. Although, I think somehow, there's an awful lot of shares of General Electric out there in the world. Okay? General Electric is probably one of the most highly capitalized companies in the world.
Thinking more about stocks about companies with very few shares.
So one question is that stocks with very few shares, okay, DigiScam, may very well not have options, an active options market, okay, because there might not be enough shares to support it, or enough interest in the market that people are actively trading these things, okay? So usually it's only the most important, highly capitalized companies that have options that can trade on exchanges. Okay? Any questions? So what do we learn from the quotes? Basically, again, if you look at the calls become more valuable as the strike price goes down, because I have the right to buy it at that price. Puts become more valuable as the price goes up, because I have the right to sell it at that price. Does that make sense? The right to sell a share of GE that's right now costing, let's look at it, it's now selling $23. The right to sell it at $60. Well, that's certainly selling for about that last sale was about 30. Okay? So that was, again, a big win. Any questions about these prices?
So why are the strike prices set at particular prices?
Why are they set at particular prices? The reason is because you want to have a standardized market, right? So the important thing is that you issue these things as standards, okay? And so you need to somehow, the exchange, when they offer them for sale, want to offer a rich enough variety of prices so that people can do what they want while still having enough trading in each one of these prices to make the market interesting. Okay? If you had a price changing at every penny, instead of this being the options for GE, that price thing would be, 100 times, 500 times bigger. Okay? And it would be harder to keep track on the market. So the exchange makes that decision based on where the stock is trading and what granularity it thinks makes sense. Usually, I think every $5. I guess it's every $2.50 here. It's the exchange's business to set this contract, okay? And they can do it differently on different stocks depending upon what it's being traded for. Any questions about that? About how to read this thing? Okay. Okay. So those are options prices. And again, what I explained, I think, what all these things mean. Okay? But the quotes let you tell you what the current options prices are. Now, let's start to think about what it is, where those prices come from. Okay? On one hand, they come from supply and demand. Because for anybody to buy one, okay, on one hand, it's supply and demand, because if everybody suddenly decided they wanted GE options expiring in 2010 for call options at $50, suddenly there would be a big, more people buying them, the price would go up. But because there's a market maker whose job it is to buy and sell these things, and because they can create as many of them as they want, supply and demand is not in principle the big driver of this. Okay? Big driver of it is what is the fundamental value of what the option will be worth. Okay? And I claim that the following following factors affect options prices. Today we're going to take a look at some simple factors and simple bounds on options prices. Then over the next couple of lectures we'll get more deep into the question of how do you really price these things. Okay, but it's important to understand the factors and why they affect it. What does the current stock price affect an option? Okay? So if we have an option to buy GE at $50 a share, okay, why does the current price of the stock make a difference? Okay, does the current price of the stock make a difference on the value of an option where the strike price is $50 a year from now? Should be yes. Why is it yes? Okay? Because ultimately the price of the price of the stock then, the difference between the price of the stock at expiration and the strike price is really the profit that comes from the options. Does that make sense? And the higher the strike price is, the more likely we are in the money already or will be in the money when it ends. Does that make sense if we draw a graph of this thing? Here is today. Here is the expiration date. Right? Here is the strike price. Okay? And we are interested, if we have own a call, we want the strike price to be above here. Right? Then. Okay? If the strike price goes up, it means if the spot price goes up, it means we are closer to the hurdle where we make money, right? And if it's gone up past this thing and it keeps going up, the further it goes up, the more profitable our option is, right? Of course, if it starts to go down, the option should be worth less. Does that make sense? So it should be clear that the option, the current stock price affects the price of the option. Any questions about that? The strike price. Why does the strike price make a difference in the price of the option? Okay? If we raise the strike price of a call option, what should happen to the price of the option? Okay? The price of the option should go down, right? Now, this is a hurdle to make money. If we suddenly raise the strike price, we raise the hurdle, it's more likely we will trip over it. Does that make sense? So clearly, if you raise the strike price, the option to buy at that price is worth less on a call option. If you lower the strike price, that option should be worth more. Any questions here? The time to expiration. Why does the time to expiration make a difference in the price of an option? Okay. What does the strike price do? The time to expiration do? Okay. I picture that the expiration time, we can think of an option as being sort of a race. Okay. Where your job, you have this stock. Your job is to climb this mountain and get to this height. If I have a call option, I am hoping that this stock will climb this mountain and get to that price. Does everybody see that? In principle, the longer I have time to climb the mountain, the more likely I will succeed. Does that make sense? Okay? Particularly in an American option. If I have the right if it's a call option, I have the right to sell at any point. Clearly, an option that I can buy anytime between here and here at this price. If you tack on this extra period and give me permission to buy anytime in here at that price as well, the option is going to be more valuable. Does everybody agree that the stock price, the time to expiration, should have a difference there? Any questions? Now the next factor is an interesting one that we haven't really talked about very much yet, which is something called volatility. What is volatility? Anyone have an idea what volatility is? What? Fluctuation. Okay? The volatility in some sense measures how much jumping around is the stock price doing. Okay? Certain prices, let's say we'll call it, Rocksteady Incorporated. Their stock price may fluctuate very little. Does that make sense? Right now, if you were an airline, during the oil, when the oil price is changing rapidly, it went up $15 last night or something like this, right? An airline stock is probably doing the same thing, this thing. Does everybody see that? So some prices go up and down relatively little, and some jump up and down a lot. Okay? So let's again picture this kind of a thing. It's not, let's say that the price is now $15 for two stocks. One of which, and they're both going to stay on average about the same. One of them fluctuates very little. The other of which is also going to hover around there and ultimately not go anywhere, but is going through arrhythmia at that point. Okay? Which one of these, how might this volatility affect the price of the option? Suppose you have a call option on one of these stocks at some strike price above what it currently is. Let's say $25. Which company would be better, would you rather have, okay, the option on? The Rocksteady 15 company, the low volatility company, or the red up and down, give you a heart attack company? Which one do you want the option on? The bounce around one. Does everybody see that? That the riskier company in some sense, okay, the more volatile the stock price, the more valuable its options are. Okay? Does everybody see that? That's kind of a counterintuitive thing. If you ask me which stock is more valuable, one that's going to jump up and down a lot, averaging $15, or one that just stays around $15, which stock should be more valuable? Okay? The one that jumps around, going nowhere? Or the one that is rock steady? Which stock should be more valuable? The steady one. Okay? There's less risk involved with this. The expectation of return from both of these companies is the same, right? There is less risk on the volatile one. So the stock is probably more valuable. But on the other hand, the price of an option, okay, is more valuable when you have a risky one, okay, a volatile one. Any questions about that?
What the strike price is below the spot price, the average price?
Well, it's sort of like, okay, so now you're telling me, what if I'm already in the money? Okay? Well, one argument would be, one thing you could say is if this was the strike price, and let's say we're at this moment here, okay? If you're afraid, my God, this company is jumping up and down, and if I'm afraid of it going down, I really want to lock it in, I better sell my option now. I'm better off selling my option now, okay, at the current, let's say, high price, okay? So I guess the answer would be is if I'm afraid of it, if I think I'm satisfied with my gain and I'm afraid of it going down because it's risky, I would be better off selling it to somebody else, okay? So the argument would still be, although this seems a little bit more wishy-washy, okay? It is a question, if I'm interested in locking in this gain, which means I'm afraid of the risk, okay, I should sell the option now, right? But otherwise, to somebody else, they would say, well, look at it. It's still going to fluctuate. Maybe it will go even higher, okay? And since in some sense I win if it gets up, the chances of up and down are the same. My multiples of winning will increase. The argument somehow is that the more volatile it is, the more valuable the option is. And if you don't believe that, you sell it and take advantage of the current. If you're a risk-averse person, you sell it and take advantage of that now. Any questions? Okay? So we will have to deal with this notion of volatility, which will be made more formal later on in the semester. Okay? The interest rates. Do the interest rates affect option prices? The answer should be, well, they must, because they affect everything else. That much would seem like one argument here, right? And we'll talk on the next slide about exactly how it is. That's a little bit of a trickier thing. And one other issue is the value of the dividends expected during the life of the option. Now, what is a dividend? Does anyone remember what a dividend is? What is a dividend? It's some money that the stock will pay its stockholders, right? Why is it that the dividends will affect the price of an option? Okay? Who is it that gets the dividend when a company issues a dividend? The shareholder, right? And so at the instant that here is the stock price, what is going to happen at the instant this company gives a dividend? Okay? If it is giving, if at this moment it's worth $10, if it's giving $2 to the shareholder to put in their pocket, what's left in the stock? $2 less, right? So the moment that check is cut, the price of the stock will go down. Does everybody see that? So what is it if you know, let's say, that your dividend date, the dividend date is here, okay? When they're going to be, you know that's the dividend date, and this is your strike date, right? Knowing that there's going to be dividends given out here means that even though the stock price is right now trading, let's say, well above the strike price, it might very well be that that because of the dividend, you will stop being in the money right after the day after they give the dividend. And this is something that's on a calendar, so you can predict this thing, right? So giving dividends is bad if you own a call, because it will lower the stock price. Okay? If you have the stock, it makes no difference. Okay? But if you have the option, it makes a difference. Any questions? So which of these values, let's go through this again and see which way should we expect if there is a change to one of these things. Okay? Let's see which way it affects the price of the option. Okay? If the stock price goes up, okay, why does the price of the call go up or down? It goes up. Why is that? Because again, you have a right to buy it at a fixed price. If the price went up, you feel smarter, right? And the price of doing that has gone up. If you have the right to sell it at a particular price, okay? If I have the right to sell this at $10 and the price is just zoomed up to $30, the more the stock price goes up, my right to sell it is less valuable, right? So the option price, the value of the put goes down. Any questions? This is one it's important people nod and see why that actually is. As the strike price goes up, okay, that's the price that I can get for, it'll cost me to buy it. If the price of my option, if the strike price, the price that I get when I have the permission to buy it at goes up, the price of the value of this goes down, right? It's more value for me to be able to buy it at $10 than at $20. That's opposite from the put. It's more valuable for me to be able to sell it at $20 than to sell it at $10. Does everybody see that? Expiration date, both a call and a put. Okay? If you call, you want the stock price to go up. If a put, you want it to go down. If I'm allowed to buy it or sell it anywhere in the future. Okay? If it's an American option, okay, The more time you give me, the more valuable it is. Okay? Any questions? Volatility. The more that the price jumps up or down, the more likely it will clear a hurdle. Okay? I guess a way to look at it, if you have a really volatile stock and it goes bankrupt, that doesn't hurt me any more than if it had gone, if I own the option, than if it just fell just under the money, right? So even in a volatile world, if it's going to go down, let it go out of business for all I care. Okay? So the higher the volatility, the more valuable the option is. Okay? Dividends, as we said, if a company is issuing dividends, that's going to lower the stock price the moment it releases it. That's bad if I have a call, and good if I have a put. Any questions? The one that is confusing, okay, and let's say more subtle, is the risk-free rate. Okay? So, just to go through it quickly, okay, if we have the risk-free rate goes up, if the rate of interest goes up, okay, and nothing else happens in the world, okay, then the argument is that since I'm later going to, let's say I have a call is a permission to buy a stock at a particular time, right? When that time comes, I have to actually buy the thing, right? So to actually buy the stock at that price, I need both the call option and I also need the cash to pay for it, right? If the interest rates go up, okay, it's very, very easy for me to either borrow, it takes very little money from me now. Let's say I have the right to buy this company for $50 a year from now. If interest rates are very, very high, go up, I can put less money in the bank now to know that I can buy it then. Okay? And so if that happens independently, the argument is it's good for a put and call and bad for a put. Now the problem is that when interest rates change, usually other things in the world change, because we've seen everything in the world happens when interest rate changes. Okay? And when interest rates go up, usually stock prices go down. Why is it that when interest rates go up, do stock prices go down? Can someone give an explanation of that? Let's think about this. At least two explanations. Why, if interest rates go up, do normally stocks go down? Okay? Anybody? Well, one, if the interest rates are higher, I get more money by putting my money into the bank, right? Why do I want to be in the stock market now, where it's all this risky? Why don't I have to put my, the higher the interest rate is, the safer, the more valuable it is to have my money in the nice, safe bank, right? The other argument is that in principle, when the cost of borrowing goes down, companies can do lots of good things with it, okay? And so that's good for a company and should be good for its stock. Any questions? Okay? Any questions? The one final point here about the directions of these changes are that this issue with dividends are one reason why European options behave differently than American options. Do we remember what was the difference between a European option and an American option? Does anyone remember? Okay. What is the difference between a European option and an American option? Someone.
Execution time.
But the time, whether you're allowed to execute the option, okay, now or any time in the future, right? And it seemed always a little bit funny. So with the European option, I could only buy it at this price on this day, right? If I had a European call, I could only buy it at this price on that day, right? Whereas European, where in an American option, I could buy it at this price any time in the intervening time, right? And we sort of argued, well, there's not that much of a difference here between European and American options. Because if you have a European option and you want to profit from it today, just sell your option. Right? But note that there is a difference in a world where you start factoring in dividends. And why is that? Suppose, let's say, that right before the expiration date, this company is going to issue a dividend. Right? Even though we're in the money over here, we may not be able to profit from that at all. Okay? Because the price is going to change right before, okay, my strike date. And I can't execute depending, even though I know the price is going to change. I can't do certain things with the European option I could do with the American option. Okay? Any questions about it? Okay, any questions at all about this? I can tell people this seems a little technical, people are a little tired. Any questions? Okay? So it should be clear that options are real things. You can buy them on Yahoo Finance, or as you see, you can get quotes for them on Yahoo Finance. It should be clear that there's several things that affect their prices. Okay? And that you really want to figure out what the right price for these things are. Any questions? So, we're going to start, if we want to start really figuring out what the price of an option is, okay, I want to start by looking at some upper and lower bounds on prices, okay, because they're going to be simple and they're still going to have some power to them, okay, so we're going to let P and C be the price of a European put and call option. We're going to make it European instead of American so we don't have to worry about, so they're simpler to deal with. We're going to assume there's no dividends, okay, because they, as you can see, mess up prices. What kind of bounds can we have? The first observation is in red. If I have an option to buy a share of stock at a particular price, okay, can it possibly be worth more than an actual share of stock itself? Let's think about this. Okay, if I give you the option to buy it, here's the current price. Suppose an option means, a call option means I can buy it anytime at that price, right? At the time that I buy it, okay, if I buy it, I will own something with this value, but I have to actually pay what the strike price is. Does everybody see that? An option plus cash equals a share of stock. Does that make sense? So if an option plus cash equals a share of stock, then an option has to be less than or equal to the value of a share of stock. Does that make sense? These are European.
So that's the option for later on.
Okay, but still, let's say I have an option to buy it at a particular price. A call option means I can buy it at a particular price in the future.
At a particular date.
At a particular date in the future. Can that be worth more than actually owning the thing? Okay? In order to buy it and sell it, to buy it at that price in the future, I need the option plus the cash. Right? So really what that's saying is that on that date, if I decide to buy it, the option plus the cash is equal to a share of stock. Right? If an option plus cash is equal to a share of stock, then by definition, the option has to be less than the cash has value, right? So if we have an equation, option plus cash equals a share of stock, then the call option has to be greater than or equal to the stock, because we assume cash always has positive value. Does that make sense? So one bound is that a call option is always worth less. Actually, excuse me, it's not that. Okay? If we take something that's big here, okay, this is positive. If it was equal, if we delete the positive thing, that means that this has to be less than that. Any questions? How many people get it? How many people don't get it? Okay? Let's look at a second bound. If I have a put option is worth, gives me the ability to sell something at the strike price, right? A put option says you can sell this share of Lehman for $100. How much is it worth for the right to sell a share of Lehman for $100? Okay? It can't be worth more than, okay, $100. Why is that? In some sense, if I want to sell, well, what is this bound saying? It says that if I have a put option plus a share, okay, I can get the strike price for it. Okay, that's the most I can get for it, right? I can't get more than that. Okay? So, the put option plus the share, if that's going to get me at most, if I'm trading it in, if I'm happy to use my put, I'm getting $100. If we delete the share has some value. Even today, presumably, a share of Lehman has some value, right? You can put it on a wall, okay? If someone's giving me for free a share of Lehman, I guess I'd take it, okay? Right? So the argument is that the value of a put has to be less than or equal to its strike price. Does that make sense? The other thing to note about a European option is that you don't actually get that $100 until the expiration date. Does that make sense? You can only sell the thing and cash it in on the day you're allowed to sell. Suppose you have a Lehman option that will pay you $100 for a Lehman share, but it's not going to pay you off for another 3 years. Yes, you will get $100 from that, right? You pretty much can lock it up now. Yes, I've got $100, but they're not going to give it to you until 3 years from now. The value of that $100 currently has to be discounted because of the interest rates, right? Is $100 in 3 years worth the same as $100 now? The answer is no. $100 in 3 years is worth how much money can I put in the bank to get me $100 in 3 years? And that means so that means that the put is really worth less than that value, discounted by the interest rate. Any questions about these bounds? Okay? All of these bounds should make some basic sense, okay, as to what option prices are. So there are constraints as to what these call and puts are, should be. Okay? We haven't yet got an equal sign. Equal signs would be good, but yeah.
So normally, the blue one should be larger than the green one. So why need the blue one?
Well, no, I think it's the other way around. If the put is less than or equal to something, in the first case, the green one, it would say the put is less than or equal to $100. The present value of that $100 is less than, okay, $100, right? The put says it is less than or equal to. Let's read out what it is. The green one here says that the value of the option has got to be less than or equal to its strike price, right? Now, I could also say it's less than or equal to 1,000,000 times its strike price. Does everybody agree with that? If my salary is less than $1 million a year, it's also less than $2 million a year, right? It's the second, the looser bound, that's less interesting.
Yeah.
Do you agree? But which is the looser bound if it's a European option? The blue bound is the tighter bound. Because In the first case, we're saying the Lehman option that expires in 2 years is worth $100, less than or equal to $100. The second bound says it is worth less than or equal to what it would take to put money in the bank now to have $100 in 2 years at the current interest rate. So the bottom, the blue bound, is the tighter bound. Okay, do you believe that? You want me to try that again?
So combine blue and green equal to the blue.
So what I would say is that it's sort of, I would say that if we're talking about European options, then if it's a European option we're dealing with, the green bound is less interesting, in fact uninteresting, always trumped by the blue bound. Okay?
So equal to the blue bound.
Not equal to, but it's sort of like this. Which is a more informative bound? Okay? If I tell you that my salary is less than $1 million a month, and I tell you that my salary is less than $500,000 a month,
So $500,000.
right, what is my actual salary?
$500,000.
No, I wish, okay? But my salary is less than or equal to $500,000 a month. It might be I'm doing this for free for all you know, right? But the tighter bound is the more informative bound. That's really what the question here is, right? It's sort of like if I'm telling you, let's draw the line. What is the value of this? Here's a number line. This is the value of the option. The first bound says the option is somewhere in between here. The second bound says the option is somewhere between here. Which is the more useful bound?
Red.
The red one, right? And perhaps the only difference is you have the word European here. This would be true for an American option. The green bound would apply for an American option as well. Okay? Any questions? Okay? Any questions about what these bounds are and why they make sense? Okay? An important issue. Yes?
We don't need a discount with the rate on the other one, on the option to buy.
Well, the option to buy is you're getting the value of it right now is the share now. Let's think about this for a second. Okay? If you right now ask me, what is a call option worth now? All I'm saying is worth less than a share now. If I give you a choice to a call option to buy a share of this at any price, could that possibly be worth more than the current price of the share? If I really thought it was worth more than the price of the share, I'd buy the price of the share now. That would be sort of the argument there, right? Suppose I have a call option to buy it right now. Okay, a call option to buy it for $0. What would it be worth? Okay? Well, it's worth its current price of the stock. That's what it would be worth, right? A call option to buy it at a strike price of $0 would be worth exactly what the current price of the stock is. As you push the options price higher, okay, the options price, call option price will be lower. And that's why that inequality holds. Any questions about any of these? Like, I don't see why this makes sense. Would be a good question. Any questions? Okay? Now, it turns out we can get tighter bounds as to what the values of calls and puts are using an arbitrage argument. Okay? And this is actually kind of a clever idea. Okay? Those other bounds were kind of trivial. Let's think about a world where there are two different portfolios. Let's figure out which one of these we want more. Okay? Portfolio A consists of a European call option. So I have the ability to buy it at price K. Okay? Plus, I have enough money in the bank. This is that discounted K, right? So that at the expiration time, I've got enough money to pay to buy it at that price. Right? Does everybody get the idea what my option is, what my portfolio is? I own a call option, and I own enough money so that I will be able to execute that call option if I want. What is the value of that portfolio at time t? Okay? I claim if the current price, the price of the stock at that time, is greater than the strike price, what am I going to want to do with my option and cash? If the current price of the stock at the time of the expiration of the option is higher than the strike price, what am I going to want to do with my call option and my cash? What? Execute it. Say, here, take the option, take my money, give me my share, right? So the value of it is worth S of t then. What if on the other end, at the time of execution, the price of the stock is gone down? It's below my strike price. Do I want to execute the option or not? So then I would be happy to keep that K dollars that I now have, that my money had grown to at that time. The claim is that that portfolio is going to be worth at time t the max of K, which is the dollars if I just keep the dollars, or S of t, which is the price of the share if I traded my money and my option. Do people agree that this portfolio is worth the max of ST and K? Any questions? Now, what if I have a portfolio B that consists of just one share? Okay? What is that going to be worth at time S of t? Okay? At time t. Well, it's going to be worth the current price of the stock. Which portfolio would you rather have, A or B? Okay? A is worth the maximum of the stock price at time t and K. B is worth the stock price at time t. Which portfolio do you rather have? Who would rather have A? Who would rather have B? Okay, it's a shame because I'd love to trade with you. Okay? It's clear portfolio A is worth more than portfolio B. So what does that mean? That would mean that a call option plus the cash, which is down here, the call option plus the cash, has got to be worth more than the current price of the stock, which is S of 0. Does that make sense? If you didn't believe it, you would rather take the other side of the deal, right? Because you can always convert that share of stock right now into the current price of it. So if we do a little bit of algebra, okay, what we know is by putting the minus k e to the rt on the other side of the expression, we know that the call price has got to be greater than or equal to S naught minus k e to the minus rt. And since a call option can never have negative value, the value of that option has got to be greater than or equal to the max of that and 0. Any questions about that? Okay. Any questions? So we now have a better bound on what the value of a call option is by using one of these sort of arbitrage type arguments. We can do a similar thing to get a price on a put option. What is the portfolio here? Portfolio A consists of a European put option, okay, to sell a share at K plus one share of stock. The value of that is either, if the stock price is high enough I'm not going to want to sell a share at that price, right? If the stock price is above the stock strike price, I am going to keep the stock. If, on the other hand, the stock price is below the strike price, at that time I will sell it for the strike price. So portfolio A is again worth the max of ST and K. Portfolio B is just enough cash that if I leave it in the bank, I will have K dollars then. Clearly, portfolio A is worth more than K dollars then, because it might also be, it's worth the bigger of two things. So we know that the put plus the share of stock has to be greater than or equal to that amount of cash put in the bank. And rearranging it, we get that argument up there that shows what the value of a put is. Any questions about that? Okay? So we do get some kind of bounds here as to what calls and puts are. Any questions? Let me show you one more, let's say relationship between puts and calls prices that is important. Okay, it's something called put-call parity, which tells you that not only are there upper bounds on puts and upper bounds on calls, but the prices of puts and calls on a stock are related to each other. Okay, that's really what this argument is going to tell you something. That the put price of something, okay, is going to be related to the call price for the same stock. Let's say we have a European put and call on a particular stock at a particular strike price. Okay? Let's consider two portfolios. Portfolio A is the call option plus enough cash to use it. Okay? So I have the option to buy a share at K, and I have enough at time T and enough cash to do it. That is worth S of T, max of STK at that time. Right? Let's say I have now the other option. I have a European put option plus a share of stock. Okay? I claimed on my previous slide that was also equal to the maximum of S of T, of the stock price at T, time T, and the strike price. Why was that? Just to review it. At time T, if I have portfolio C, either I can get K dollars by cashing in my put and my share of stock, or I could throw away my now worthless put and keep the share of stock. So what's interesting about this? I mean, we'll see what the two portfolios are. Any questions about what the portfolios are? The interesting thing is that you have two different portfolios that at time T are going to be worth the exact same amount. Okay? If two things are going to be worth the same amount in the future, are they worth the same amount now? And the answer is yes. Because if not, it means that one of these things is either under or overpriced. Right? Because the payoff is going to be in the future is fixed. It's the same for both of them, exactly the same. So the current value of these things must also be the same. And since one portfolio on the left is portfolio A, it's a call plus cash in the bank. And portfolio the portfolio C was a put at that price and a share of stock. We get this relationship, one equation that gives us the value of the put and the call the call and the put, as a function of the current strike price, the strike price, and the interest rate. Any questions about how that came about? If we rearrange the terms, that would be call minus put equals current price minus the cash, right? So it gives you a way to figure out what the difference in price between the call and a put at a particular, for an option, should be. Any questions? Okay. American options are harder to reason about, but basically similar bounds, okay, hold. The only difference turns out to be whether or not you use the discounted value of the cash or the real value of the cash. Okay? But basically, this put-call parity gives us a way to link the prices of call and put options based on what we actually own. Any questions? Let me give you one other way to look at this, because this is kind of interesting. This now gives us a way to price these call and put options a little bit, or at least a tight relationship between them. Okay, and this may be a more visual way to look at what that actually is. Suppose I own I have a portfolio where at a current strike price, I buy a call option at a price K, and I sell a put option at K. What is the price? What is going to be the payoff response for the call option that I own? Okay, if this is strike price of K, the payoff function as a call option goes like this, right? If the spot price gets above it, my call option pays off. If it's below it, my call option is worthless, right? What if I now sell a call option, sell a put option at strike price of K? What is my payoff function going to be from selling the put? Well, buying the put would have looked like this, right? So selling the put would look like this. Does that make sense? So what happens to me? What is my payoff function? If I own a call, forget about the prices of these things, okay? But suppose I own a call and I sold a put at this price. What's interesting is every time the dollar goes up by $1, I make $1, right? Every time the price goes down by $1, I lose $1, right? What other security do we have that has the property that when the price goes up by $1, I make $1, and if the price goes down by $1, I lose $1? Actually owning a share of stock, right? Doesn't that have a same-shaped curve? Okay? So what does this tell me here? Okay? In particular here, okay, the payoff is going to be call minus a put, okay? Let's take a look at these two things, same. Okay? The payoff function for this thing, I claim if I own this call and sold this put, my payoff function is the strike price, the spot price, the price at time t minus the strike price. Why is that? If this price is above K at time t, I make the profit of that minus this. If the price is below it, because I sold the put, I lose strike price the spot price minus the strike price. Does that make sense? Okay? If the price is so much less than this, the difference between this is what I lose. The interesting thing is that my payoff at time t is going to be the price of the stock then plus, okay, minus the strike price. Well, what is that in present time? At time t, what is a stock at price t minus k units of cash worth? If that's what it is at time t, what's it worth now? Well, the right to have the stock price at time t is what it means to own a share of stock, the price of which is now S0. And the value of k dollars at time t now is the discounted value of those k dollars. So if you believe that argument, the portfolio consisting of me owning a call and selling a put, meaning call minus P, has got to be the current price of the stock minus the discounted value of the strike price. Okay? And rearranging those terms is exactly the call parity relationship. Any questions here? Okay? On one sense, this is just algebra, and algebra is boring. Okay? On the other hand, what should be in realization is that we are starting to get prices on these options. Remember, what is it that quants do? Okay, if you sort of say, in one word, what is it that quants do? They say, oh, we price options. That's what you always think they do. It's not all that they do, but that's one of the big things that they do. We are almost pricing options here. Okay, why do I say almost? Well, we have an equal sign. That's good. The trouble is that we still have two variables in here. The call option price and the put option price. Right? But we are making progress as to what the prices of these things actually are. Any questions about that? Okay? Any questions here about this or options pricing or anything that we've talked about so far? Got 10 minutes, and then I'm trying to figure out. Oh, okay. What did I say? Yeah. Let me start. Oh, okay. Tell you what. Let's talk a little bit about the projects. Okay. I could go on to interest rates, but let me talk a little bit about the projects because I got a lot of people coming by the other day to talk about. I passed out the projects on Thursday. And I got a bunch of mail from people, oh, can I do this project? Can I do this project? And I'd like to tell you one thing I've discovered is an invariant, okay? In all my classes back at Stony Brook, I give out projects, research projects like this as part of the course thing. And inevitably, the students always cluster around and fight desperately to get onto what is the worst possible project for them, okay? That's why if you look at my past list of projects I gave out, if you look at my website at Stony Brook, you'll see I'll have large numbers of projects. And I'll star what are the interesting ones. And invariably, everybody goes to the ones that are not starred, that are vague, that are impossible to do, okay, that require data that I don't know how to get a hold of, and you probably won't figure it out either, okay? This year, I tried to solve that problem by deleting anything except that I thought would be a relatively good project. That said, I have already seen signs that people are clustering around what is the worst of the remaining projects. Okay? And so I want to talk about this a little bit more and try to guide some thinking here. Okay? One group of projects that I've been trying to urge people towards, okay, are giving presentations. Remember, I outlined a sequence of 7 20-minute presentations about technological matters. Okay? These projects have several good properties to them. One is they are completely specified as to what you have to do. Two, they are dealing with things that are important things in the real world to understand as to why these are important things. Okay? They are manageable. There is low volatility projects. Okay? They tell you what to do, They are interesting things. The reason I want you to talk about them is I think that they are interesting. And I strongly think that most of the people in the class should be picking those projects. Okay? So far, no one has bid at them. Okay? But why has nobody bid at them? It is because students instinctively pick the wrong projects. That's what I'm trying to tell you. It's not a trick on me. You must be thinking, I'm trying to trick you. Okay? I'm trying to get you to do a bad thing. Okay? I think that would actually be a good thing for most projects, particularly for the master students. Okay? Because a lot of the other ones, they are somewhat vague. Okay? They are somewhat independent. The odds that you're really going to, it's easy to say, okay, I now understand this paragraph. Now, where do you go from this paragraph? When I tell you, well, build something to find the optimal way to bet on options. Well, I'll say, go off and do it. Okay? So I encourage people when they think about their projects to think about the presentation topics. Does anybody have the list of projects that I gave? Can I borrow that sheet for a second? Sorry, somebody pass forward the list. Can I borrow that sheet for a second? So among the presentations that I would like to see, one has to do with looking at markets. Markets are a very interesting thing. Okay, there's right now, I am worried about who's going to win the presidential election in the United States. Okay, I'm not in the United States. I don't know. How do I know who's going to win the presidential election? Turns out I go to an election market and I look at the current price for a security on what it costs to buy the victory of Barack Obama. Okay? And the price of that security has been going up. So I know that right now things are trending Obama's way. Okay? That's an interesting thing to learn about. Prediction markets, great thing for people to give a presentation about. We're talking here about options pricing. What option pricing tools are out there? Okay, seems like an important and relevant thing. If you are going to be a quant, you are going to go work for these people. Figuring out what actually kinds of things are available, what tools are there available in this world, what is available at the university, what's available in the world, what kind of things do they do is an interesting thing to do. Okay? The R statistics library, we're going to talk here about time series analysis. There's an amazing tool that is out there for doing these kinds of things. Okay? And I think learning how to use these kind of tools are important for being able to do this kind of analysis. That would make a great presentation. Things on trading simulations. How is it that you validate a trading strategy? That would be an interesting thing to make a talk presentation about. You guys are fortunate to be at a university where you have a data set called CRISP, which is a data set of stock prices and things like this. That really gives you a tool to do certain experiments. And what kind of data is interesting? Why is it interesting? How do you get access to it? Those are practical and interesting things. You have access to data from risk metrics, which is something about how is it that what risks might you be exposed to when you buy a portfolio. These are interesting things to learn about. Why do they work? How do they structure? You have access to a system for stock prices, a system called Reuters, that is seemingly a very powerful and interesting thing. What is available? How do you use it? Why is it interesting? These would be good things to give presentations about, and I encourage groups to find that out. Any questions? Okay? Any questions now about any of the other projects? Again, I'm trying to lure you in this direction because I believe it is good for you. Now, many of you will resist this advice. Okay? But any questions about that? Any other questions about projects? About any of the other projects or how you form groups? Yes?
Is there any resources that you suggest that we find out?
Well, what I would recommend that we do is the following. First thing I'd recommend that you do is you find partners. Okay? And one way that you could find partners is, I will help people find partners in the following way. At the end of class, if you're interested in finding partners, maybe I'm going to sort the room into different parts, okay? And I want you guys to sort of maybe meet up with people then, okay? And find people who are interested in these kind of things, okay? Once we've got groups of people that are interested in the projects, I'll then be happy to talk to you about resources and things like that. But I don't want to talk with everybody individually. about these things, because there are a lot of bodies in here, and most people are ultimately shouldn't be picking the same thing. Any questions? Okay, so think about it. If people want to be mated for projects, come on down and talk to me. If you want to go talk to your friends and figure out what's going on, go talk with each other and then come by and find me. Any questions? Any other questions about the project or anything else in here? Okay, thanks for your attention, and I will see you guys. Next class we will talk about interest rates and then get more deeply into options pricing. Any questions? Okay, thanks for your attention.